What's up guys, it's James Allen, the Out-of-State Investor, and over the past month we've been starting to see a serious shift taking place in the housing market, with mortgage rates going up higher than we've seen in over a decade. We're starting to see more inventory building back up, we're seeing less competition on houses, and more people are getting priced out of the housing market. Now with all this going on, it has a lot of people wondering if now might be the perfect time to cash out, sell their house, and take their profits once and for all. Well, I was one of those people considering this, and ultimately I decided to sell. Now I'm going to tell you why I decided to sell and why now might be the perfect time to do that. But before I get started on that, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. So for those of you who follow the channel, you know I'm not a very big believer in trying to time the market. Nobody can do it really. If you go back to 2018, at the end of 2018, we started to see a shift in the housing market. Things were starting to change directions as the Fed started to raise interest rates. Well, the Fed ended up changing their minds and decided to start lowering interest rates again to spur more growth in the economy and the real estate market. Now, if I take you to 2020 when the pandemic took place, the Fed went all out lowering interest rates to 0% for the federal funds rate, and they started buying a bunch of mortgage-backed securities and treasury bonds, driving down these mortgage interest rates to the lowest rates we've ever seen, which ended up contributing to a housing market that went nuts, with house prices growing to all-time highs and at rates that we've never seen before. All this to say that nobody can accurately predict what will happen with the housing market, because there are just some things that we cannot foresee happening in the future, such as what happened in 2020 and in 2018. So with that said, there are still no shortage of people talking about a housing crash coming up this year or even the beginning of next year. So let's just take a second to think about that. First of all, the housing market moves slower than the stock market. So for the stock market, when the pandemic took place in 2020, we saw a 30% drop in prices across like the S&P 500 over a month's time. Now in that same month's time, we only saw housing prices dip about 2%. Now when it comes to house prices are largely dictated by supply and demand. So when there's low supply and high demand, house prices go up. When there's an abundance of supply and very little demand, house prices go down. Well, right now we're sitting on some of the lowest amount of inventory we've ever seen, sitting on less than a month's inventory. Now to put it in perspective, a balanced market is anywhere from 4 to 6 months of inventory. And if you went back to the last recession we saw with housing, which was back in 2008, we were seeing close to 12 months of inventory. You can't go from less than a month's inventory to close to 12 months of supply in just a couple months. It takes time for that to build up. But even with that said, we do have to acknowledge that things are starting to change, that we are seeing a huge shift in the housing market take place. Mortgage rates are already up almost 3% from their all-time lows in January 2021. And on top of that, the Fed has started changing their tune. They've started raising the federal funds rate. They've started to sell off their mortgage-backed securities and treasury bonds, all of which contributes to raising mortgage interest rates even higher. Now, all of this has started to cause serious affordability issues. People are starting to get pushed out of the housing market, and so we're seeing a great slowdown in the housing market right now, and lenders are starting to try to get more creative and really pushing their adjustable rate mortgages as a result. Now, these adjustable rate mortgages are very important to pay attention to because they actually played a huge role in the 2008 housing crash. Now, the way adjustable rate mortgages work and why people would even do them in the first place is if you have a 30-year fixed rate, let's say the lender offers you a 30-year fixed rate mortgage at about a 5.75%, you may be able to get an adjustable rate mortgage for 4.75%. So it's a little more appealing because maybe you got priced out of the house that you want to buy with a regular 30-year fix, but maybe you can afford it with that adjustable rate mortgage. In addition to that, it's also fixed for a certain time. So you may have it fixed for 5 years, for 7 years, for 10 years, and then after that 10-year period or 7-year period or 5-year period, that's when it starts to adjust with the market. So maybe you're thinking, I'm only going to live in this house for 5 years. I'm only going to live in this house for 7 years, and then I'd sell anyway. Where the dangers come with adjustable rate mortgages is, say in 5 years time after your fixed rate is done, you wanted to sell the house, but let's say a housing crash took place, you're unable to sell without taking a massive loss. So in that situation, if mortgage rates were much higher at that point than they are right now, you're stuck paying a much higher payment on a a monthly basis than you were when you initially got the mortgage. This is how a lot of people ended up losing their property to foreclosure back in 2008. Now, to be fair, 2008 was even worse because you would have these teaser rates that would last for the first year or two, and then you'd go into this adjustable rate mortgage from there. So that's even worse. We haven't reached that level of insanity yet, but we are starting to see a rise in adjustable rate mortgages with more and more people starting to entertain that as an idea. Now, before I go any further, let me take a second to introduce today's video sponsor, which is Realm. Realm is a great app that you can use to estimate the cost of home repairs and the return on investment you'll get from doing them. Now, I could tell you from personal experience that when you fix up a house, there's certain items that are going to give you a higher return on investment than other items in the house. And because of that, it's so important that you know where you can put your money to fully maximize your return on investment. Whether you're looking to do a fix and flip, maybe you're looking to fix up a rental property, or you're just looking to fix up your own primary residence and just maximize the return on investment you can get with that. Well, the Realm app is the perfect solution to do just that. Whether you're looking to flip a house and you're trying to figure out how much profit you can make, well, you can use the app to accurately estimate the cost of repairs. If you have $10,000 to spend on your personal residence, do you want to use it towards flooring and paint, or do you want to use it for a kitchen renovation? Well, you can utilize the app to help you make that decision. You can also use the Realm app to track the value of your property just like you would any other investments in your portfolio. Either way, it's a great app to use, and best of all, it's completely free to download. So download the Realm app, link in the description below, so that you can start maximizing the value of your home renovations. And with that said, let's get back to the video. So with that said, some of the biggest concerns right now in the housing market is if more and more people continue to take on these adjustable rate mortgages, that is a very risky style mortgage to take on, and that's what played a huge contributing factor into the 2008 housing crash. Secondly, it's how much more are these mortgage rates going to rise? We already know the Fed is planning to sell more of their mortgage-backed securities and treasury bonds, which is likely to increase interest rates from where they're at now, pricing even more people out of the market. So with all those things considered, I think it's really unlikely we're going to see some tremendous price growth in the next couple of years. We're probably going to see very minimal appreciation at this point with the slowing down of this housing market. Now, I said minimal appreciation because I don't believe that we're going to see price declines. I don't think we're going to see the housing market actually crash, that we're actually going to see prices go downward. And the reason for that is I think that there's a lot of people that want to stay put where they're at. They don't want to sell their house. They've locked in these all-time low interest rates, and it makes zero sense for them to sell. So for those people, they're going to end up staying put, which is really going to limit the amount of inventory that's going to come on the market. In addition to that, new construction is also starting to slow down, with housing starts and permits starting to decline. So we have this ongoing battle between demand, where it's starting to taper down, but then you also have supply that continues to be a problem. Now, regardless of all that, if interest rates do continue to rise, there's going to come a point when it just becomes too ridiculous, where it just becomes too unaffordable. And even though it feels like that right now, we're not there yet. But if we do get to that point, eventually we're going to start to see prices correct. So with all that said, there's definitely a lot of unknowns ahead, but there's also a lot of warning signs of what could be causes for concern with the future of the housing market. And so because of that, I decided to sell. Now, I'm not selling my entire real estate portfolio, but what I am doing is I am taking some chips off the table. For one, I have a property that used to be a primary residence. I turned it into a rental property here in the Phoenix area. Now, for me, this property was one of the perfect properties to sell, and this is the reason why. For one, it almost doubled in value in less than 3 years. I bought it for $355,000, and then I ended up selling it very recently for $620,000. Secondly, it wasn't a great cash flowing property, because although it produced a few $100s a month of cash flow after all expenses, when you consider the amount of equity trapped in that property, it could do so much better elsewhere. So as I was going through my options, I thought about refinancing, but that didn't seem to be a good idea because of the higher interest rates, pairing that with a higher loan amount, and I'd be looking at a pretty bad negative cash flow property. So really my choices were I can either keep all this trapped debt equity in the property with minimal cash flow, or I could sell and use all that equity property to go make me a better return on investment. So right now, that's exactly what I'm looking to do. I'm looking to put my money into better cash flowing properties. I've been able to capitalize on this amazing appreciation we've seen over the last few years, and likely with the way that interest rates are right now, it's not very likely we're going to see much more growth in the next coming years. So right now I'm looking to buy my first commercial multifamily property, and the best part about selling this property was that it used to be a primary residence. So when you live in a primary residence for 2 of the last 5 years, you actually get all that profit without paying taxes, up to $500,000 of profit if you're married, or $250,000 if you're single. So considering it's been close to 3 years since I purchased that property, it's not likely in the next couple of years I'm going to see that much more growth with interest rates being as high as they are right now. And in addition to that, if I was to wait longer than that holding that property, then I'm forced to do either a 1031 exchange, giving me a limited time to identify a property, or take the tax hit. Now on the other hand, I'm definitely not going to be selling any of my good cash flowing properties, and I'm also not going to be selling my primary residence because, like many others have discovered, I'm going to be paying more than double to upgrade my primary residence on my mortgage payments, so that makes 0 sense whatsoever for just a slight upgrade. But with that said, my plan with my primary residence is to turn it into a rental property. This is what a lot of people are starting to do more and more, because those people who were able to lock in those all-time low interest rates, normally these houses in good areas, they don't make for good rental properties because they're normally cash flow negative. But because of the way that these interest rates have been so low, they actually work as rental properties now, and many people are able to cash flow on these properties. So you're able to get that cash flow and appreciation because you're taking advantage of those low interest rates. It's also in a great location, so over the long term, it's going to see some great appreciation, and my plan is that eventually one day I'll sell that house, and then I'll be able to turn that profit into buying an apartment complex somewhere else in a much better cash flowing area. So overall, right now, my thinking is that it's not a bad time to take some chips off the table, especially if you got some properties that have seen some nice appreciation over the last couple of years, but at the same time, maybe they're producing very minimal cash flow. I'm also not going to stop buying real estate at this time. Like I said, I don't believe in trying to time the market. I believe if you could find a good deal that's below market value, that's always worth pursuing. So I'm going to continue to look for those. But with the market shifting the way it is, I think it's very important right now to be prepared for what could potentially be a market downturn in the future. We don't know when or if that's going to happen, but you want to make sure you have adequate reserves. That's for yourself personally, and if you have properties, you want to have reserves for that as well. Secondly, I highly recommend that you do not speculate on appreciation. Now, normally you don't want to do that at all, but especially in this stage of the market, I would definitely recommend against speculating on appreciation. And thirdly, try to focus more on investing for cash flow and improving your cash flow situation as a whole. So that's where my mindset is right now. And with that said, I hope you guys enjoyed today's video. And if you gained some value, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe and hit the notification bell to watch more content like this. Also, let me know in the comments below, are you taking some chips off the table? What are you doing right now in today's housing market? Finally, follow me on Instagram and TikTok at The Out of State Investor. Thanks again for watching, and I'll see you on the next one.